right, Sofia. Well, it's almost end of the day, so a lot of you will probably be tired, but let's make a little bit of action. So, a lot of industry developments, I think, over the past time. By the way, maybe unnecessary to say, but if there are questions, scan the Slido code and you can just insert the questions. There will be a Q&A session afterwards, the panel. So, focusing on the industry development, guys, over the past years, I can say, and with the eyes on the future, what do you think will most likely shape the crypto investment sector for the, let's say, the coming 1 to 2 years? It's an open question to you all.
Okay, thank you. Thank you for being here. I would say the short answer is TradFi. I believe investors, most of them are underestimating how quickly capital markets are moving digital assets into traditional rails. We have seen it with ETFs. We now see it with treasury companies. The soon-to-be open managers of retirement accounts, their allowance to invest in crypto. And I think this is just the beginning, and this is starting to shape crypto not only as a speculative asset, but a more mature part of a natural part of a long strategy portfolio. So, and with the risk of becoming a meme, I would say stablecoins. Stablecoins are the killer app now, the hottest buzzwords, along with RWAs, but I think it's still early about them. But stablecoins are already bringing amazing cost efficiency in many sectors and many entities. And in 2026, we will see much more examples of legitimate use cases for stablecoins in e-commerce and also in payments and settlements.
So to add on this, because I think it's basically TradFi is the short answer. But if I need to do a recap of like what happened in the last 5 years, I would say that, you know, especially with DeFi and like all the development in Web3, is basically we figured out what works and what doesn't work. We tested a lot of things in production. And now we have the building blocks to integrate these things into TradFi and to start to improve the processes that are happening there. You know, stable coins are one example, because, you know, they're very efficient. They allow to move money much more quickly, to do settlements much more quickly. We also have perps that are allowing like leverage and stuff like that, like efficient trading and all this. So it's all kind of come down to how do we integrate all this in TradFi. And I think TradFi also grew to the idea that it needs DeFi, because, you know, it sees that it can make money out of it, basically. So it's all about financial incentives. So I think I'm thinking more towards, I don't look for new primitives so much, but more like plumbers that are going to allow the right plumbing of all these systems in order for the money to flow in TradFi, basically.
Hi, everybody. My name is Borislav. I'm from Morningstar Ventures, which is an early-stage venture capital firm, so we have a little bit of a different lens. Without a doubt, stablecoins are going to be the elephant in the room, and I think a huge testimony to that is simply the players and the sheer amount of stablecoins that are coming to the market. So just recently, for example, Circle announced their own blockchain for better settlements, you know, faster timing. At the same time, Paradigm is working with Stripe on their own layer 1 Tempo. And all of these guys are not building in silos at this point in time. They're also integrating with huge platforms like Shopify, like DoorDash. You know, so I think we throw these numbers around, you know, USDT is 170 billion market cap, USDC is 75 billion market cap. But, you know, comprehending what the impact of that is once it actually gets into everyday applications, you know, everyday usage, I think that's going to be massive. And without a doubt, with what the other two guys said, the tokenization of financial products like equities, like mutual funds, putting all of this on chain, that's going to bring massive liquidity, and I couldn't be more bullish for the next couple of years that are to come.
Thank you. Well, I can totally rely on what you're saying from my position. And I indeed think that TradFi, well, at some point will integrate everything that we have been seeing created over the past years. Now, we can also see that America is again in the forefront of developments, and we can even maybe say that there's some kind of a deregulation. Definitely when it comes, for example, to Trump's 401k, the act that he has signed, that it's now allowed to introduce hedge fund managers and pension funds to invest into crypto, or Bitcoin in general, but in crypto in a broader space. Now, do you guys think that there's actually deregulation, and do you think this is driving innovation, or would you say, well, I do have another perspective on this?
Perhaps I can kick off. On the one hand, it is deregulation, but I don't think that's the correct terminology. I don't think that people that have been in crypto long enough are actually scared of regulation. We're just looking for the right regulation. Under Gary Gensler, it was basically choke point 2. It wasn't healthy regulation. It was just going after players, making it difficult for builders to build in the space. So I kind of see movements such as, the latest legislation coming out of the US regarding stablecoins, the tax structures, the unification of ETF issuance. All of these are kind of necessary moves to just provide the framework for people to kind of play along, right? So I definitely think it's a step in the right direction. Regarding 401ks, I don't really want to go into detail because I'm not a specialist myself. From what I understand, that's actually an executive order from the Trump administration that hasn't really been voted or gone into effect, but it definitely opens the door to a, $9.2 trillion pot of money that, if even a fraction of that kind of gets allocated to alternative assets, crypto included, that's massive, right? So I think it's definitely a step in the right direction. A lot of work needs to be done and a lot of change of sentiment needs to be done, because if you ask normal retail consumers, they're still scared of what happened to FTX. They're still scared of what happened to a lot of borrowers and lenders. And changing that perception before they put their retirement money is a necessary step along with regulation. And yeah.
Yeah, when we talk about how the regulatory landscape changed in basically the last year, I think it definitely became more crypto-friendly, and the main outcomes here are ETFs, DATs, the digital asset treasury companies, which both of these couldn't happen under Biden administration, no way. And I think the third one will be the acquisition of Bridge, basically. So like a big Web2 company acquiring a company with crypto business. I think this is also a kind of one of the catalysts out of this. It's not so much deregulation, but more like a friendly stance against crypto generally. So these three things, I think, are one of the major movers of the crypto space at the moment, and they kind of show where things are going, basically.
I believe Bridge was acquired even a year ago during the Biden administration, which was, yeah, they did, which was a signal for where the market is going. I think here we can zoom out a little bit and think about a longer term of maybe the next 10 years. So it's pretty normal for young people, Gen Z and millennials, per a recent study, the cohort between 25 and 41 years have around 28% of them have some kind of crypto exposure, and the older cohort is only 5%. And if you think in the next coming 10 years we're going to see a massive amount of wealth transfer from older generations to younger people, and younger people which are just now going into their prime saving years. And if we are looking from this wealth transfer to younger generation, some might say it's about $100 trillion. For sure, some of this wealth will pour into digital assets, and they're just making sure there is the right regulation that can secure future investors. And by saying investors, I also think users, because everyone who is taking the Ethereum network, everyone who is actively participating in a DeFi pool or something, even if it's USDC denominated and low yield, low risk, he is still a user and is actively using DeFi. And now we have these use cases which are pretty strong, and people who are actively participating into crypto, they're just making sure they're secure enough.
Well, I think we can draw our conclusions from that. However, we were just talking about retail and also, well, that the way opened for TradFi. Now, I think what I am wondering, and maybe the audience as well, is it mostly the institutional players who are going to benefit from, well, everything that's happening, the right legislation, as you said, or will it also be retail that can actually benefit from the changes?
Of course, retail is going to benefit, and I can tell you, like, I think a lot of people here, we are living in a little bit of a bubble, especially users of DeFi. DeFi is very complicated. Like, even if you don't look at it from a technical perspective, for a user, it's very complicated to use these things. I mean, for somebody that's been, clicking, DeFi buttons for like 5 years, it might look like trivial, depositing funds on Aave and stuff. But the thing is, if you take a regular person and show him like all these things, it's like way over his head, and even some financial people, it will be hard to grasp the whole thing. So the moment when we integrate these things in products that people are actually used to use, that are familiar with, let's say apps like Revolut, like everybody's comfortable using Revolut, right? So the moment when we have like an earn button in Revolut that plugs directly into DeFi, and it's already happening. It's happening on Coinbase. Like Coinbase right now, I think just a few days ago, started integrating Morpho vaults into their UI. Before that, they integrated loans. So suddenly, this thing with TradFi in the front and DeFi at the back, it's starting to materialize. And I think this is amazing, because this is going to allow 100x more people to actually use these services. So this is a great enabler in my opinion, and it's something that a lot of retail is going to benefit from.
I mean, unfortunately, it's a little bit boring when the entire panel agrees on every point, but he couldn't be more right. I would just bring it back to specific legislation. For example, the Genius Act that was passed. What does that require issuers to do? Basically show that they have sufficient collateral, have regular reporting, and what does that allow for every other Web2 integrator and general app to basically work with them. So clearly that's going to benefit retail. On the ETF front, you can see that institutionals are basically the biggest buyers in the US because they're deploying 50 to 100 million checks, and the AUM is just much larger. At the moment, I believe the BTC ETF holds something like 170 billion, which is an insane amount, and it's the fastest growing ETF ever, I think. So, while institutions are benefiting and are coming on board, if you just move over the border in Canada, actually the BTC ETF was bought up by retail first. Then you move on to Hong Kong, ETFs were not available to retail, right? So I kind of feel like it's a catch-up game where the regulation opens the doors, it provides the railways for people to participate, and it's just a matter of time to, kind of unify security, user experience, and bring more people on board.
When you say the ETF and the asset under management in the BTC and Ethereum ETFs, actually institutions were first. These were the big inflows at the beginning were institutions, but as of now, the bigger portion of investors in ETFs are accredited investors in the US. And these are people who haven't had any crypto exposure before them. That this is just a product that enables them to invest in something speculative, risky, a small fraction of their portfolio with an instrument they know. And when you say the bubble, I said the bubble is the billion, the golden billion of the world population, which is basically living in established markets. But ETFs and they're just lowering the barriers for many participants. We have people around the world which are not able to make a truly diversified portfolio, and as of now, they're just starting to do that. And with the new regulation, we actually, here in Bulgaria, we can invest in many things, but it's not the same across the pond. It's not the same in the US, and that's changing now.
Okay, well, as you said, quite a boring panel, huh? Everybody agrees. Let them give where they came from. So we're mentioning a lot of things. I hear ETFs, I hear DATs. Let's focus on that last category, the treasury companies. Yeah, is this mainly speculation? Is this rather wise investing? What are your opinions? I mean, we can see that companies like MicroStrategy and Sharpling Gaming at this point are buying treasuries like Bitcoin, ETH. I think it's going to happen with Sol as well. What are your opinions on this, guys?
I think there are two types of companies here, although you can say even like MicroStrategy and everybody else. But basically two types. One type is buying these things on leverage, aka MicroStrategy. And in my opinion, this is like very dangerous. It could lead to it could be a catalyst for a huge bear market. I mean, probably not going to happen right now, but like in a few years, why not? So this is like a very scary thing. Then you have the other type of DATs that are not buying stuff on leverage. And these are what I call them like reverse tokenization stuff. So we were all saying like, oh, like everything is going to be tokenized, but actually it happened the opposite. The tokens got TradFied, basically, where obviously there is a lot of demand for buying these instruments from regulated players who can't make a Binance account. So you take the tokens, you put them into a publicly traded company, and suddenly everybody goes crazy. Like this is actually very similar to what happened with ICOs. I mean, in a sense, although money are not invested on just white papers, but more like on shitcoins. But the thing is, these instruments are traded in a major premium to the underlying assets that are staying in these companies. And there is a lot of speculation happening. Like when these DATs are announced, the prices go like 10x. So speculators try to catch that. So you have this part, then it slowly drains. And then you need to keep in mind that the private investors are first in line here that are going to acquire these instruments, and then they're going to dump them on the market. And I'm saying this as someone participating in such round. So, so basically you acquire them at a premium because it's a private round. Then the moment when they become liquid, you're able to sell them. So don't buy these instruments when they become tradable. Wait for the private investors to unload first, and then it's like always make sure that what you're buying is matching the assets under management that are staying in these companies, because right now it's just a bunch of people trying to make money out of this thing.
Yeah, I'm a little contrarian to that, in the sense that everything Valentin said is correct. Apart from the fact that I'm less worried about MicroStrategy, I'm actually more worried about small ghost privately trading companies on the French stock exchange that until yesterday used to be real estate related, and then all of a sudden they're like an Ethereum treasury which is going to stake and have passive yield and all of that. I think that we are yet to see one of these fault or have a security breach. We are already seeing how the MNAV is kind of going towards 1 and even below, which basically signals that there is less demand on the market for such. However, having said that, having a Michael Saylor, having a Tom Lee, having Kyle from Multicoin being representatives of these assets and allowing a publicly traded vehicle for institutions to invest is definitely a good thing, right? Like it's more exposure, it's more money coming in. Is it actual adoption of crypto? Is it revolutionary? Of course not. But is it beneficial to price action, to exposure, to them being on CNBC and all of the huge outlets every day speaking about crypto? I wouldn't dismiss the effect of that as well.
I think you have first to make the difference, the distinction between is this treasury company is holding Ethereum or holding BTC part of their core strategy. And this is the one type of companies that we're speaking of, and public traded companies. And I don't speak about private, that's a whole different story. And the other type of companies are just companies that are just trying to get some hype and pump their stock by having some exposure to crypto. I think this is the risky part, because if we go in a downward phase of the market, I'm less worried about SBET, SharpLink, and BitMine. I'm actually worried about these companies that are just risking their treasuries on a very risky asset. Because SharpLink, they have a long-term strategy, and first of all, Ethereum is a productive asset, so you can stake it, you can make the most out of it, and this is the long term, and they do not take any debt by doing so. For MicroStrategy, it's a different story.
Well, it sounds to me a little bit like a bubble. And it reminds me of the zeros, where we had the dot-com bubble. Not saying that everything is bad, because look at the internet, we can't live without it at the moment. Imagine a world without internet. Well, I guess nobody can do that. But I think we should all agree on the fact that at some point a bubble bursts and then capital is gone and then everything can start again from zero, from scratch, and then build up. However, the technological evolution that is at the ground of the bubble, that will stay. Now, based on the bubble, everybody always wants to know what is the new thing. It's so funny. Every time I speak to an investor, they're asking me, yeah, what is the new thing for 2026? Well, stay here, it will be revealed. We see a lot of industry developments. For example, we see crypto sports betting, we see AI coming up, we see DeepIn, play to earn gaming, all kind of these kind of developments. Which of those three do you think will most likely set the investment landscape for the coming 1 to 2 years?
Okay, I'll start first. Well, you mentioned gaming. Gaming is extremely hard. I don't know if you're familiar with the gaming industry as a whole, but it's incredibly consolidated in the big studios, and like 95% of the gaming revenue is going into a couple of franchises and good sequels. And the rest is a very, very hard market. And when it comes to blockchain, it's even more difficult because you have to make a great game that's universal. And then you have to, on top of it, lay the foundation, the blockchain thing, and the whole token economy, and the incentives, and everything else, and make the technology robust. So I'm pessimistic about blockchain games thriving, but I'm optimistic about gaming infrastructure. I think we are in this phase of the market. It's an incredibly centralized market, and it will open. And we haven't seen the narratives in gaming which were quite popular, like digital assets transferring from one game to another game. This haven't happened yet. Maybe in Axie Infinity, which still has many players, but otherwise it's not yet there.
Finally, something we can disagree about. So, within Morningstar Ventures, we actually have a whole gaming division where we run our own guild. We have 200 people who are developers, designers, content creators, bug hunters, and we use these people whenever we do the due diligence process before investing, and then afterwards we help projects during their development phase. And our largest investment to date actually is a gaming project called Ganzilla. It's a team based out of Germany and the US at the moment. There are 400 people, 4 million monthly burn. They run their own subnet of Avalanche. They have their own blockchain, and they have their first AAA game called Off the Grid. So I agree that, you know, after Axie Infinity, there were just a lot of replicas and a lot of bubbles that unfortunately had to come along. But, you know, these are seasoned players seasoned builders who actually have previous experience in building Web2 games. And currently, OTG, for example, has 400,000 daily active users. Additionally, they have 16 million unique wallets that were registered on chain. You know, exclude all the botting and, you know, all the farming that's put there, cut it by half, or, you know, even 25%. That's still a huge move forward. And the one thing that I want to convey, you know, not to sell our own bags, is that they're the first ones that were able to crack Steam. So they're on PlayStation, Xbox, Steam. You know, these are huge outlets where there is millions and millions of players. And if you crack the gaming, the product phase, and people realize that there is a marketplace where you can trade assets, you can make some, you know, actually money on the back of the time that you spent and the attention that you pay to the game, that could be actually quite revolutionary. Because previously what happened is actual gamers, everybody dismisses them, but they're actually the fastest adopters of technology. They're also power users. So whenever you give them a shitty game and you just slap a token on it and you tell them, oh, here is the next big thing, of course they're going to be skeptical and see it as a scam. Now I think that this is one of the projects that has a chance to kind of turn things around. It's not going to be easy. We're in very close contact with the team. They're currently going to their mainnet. So it's an effort and a half to also move all of these 16 million wallets and, you know, kind of integrate the token and, you know, make the economy work. But I think eventually, whether it's them or not, I don't know. I can't tell the future. Somebody will crack it. And then if you put two games side by side, and one of them has all of the DeFi elements, crypto ownership of digital assets and transferability, and the other one doesn't, I think it's pretty self-explanatory which game is going to be to win, right? So I think it's just a matter of time until that segment has its time, and I hope it's sooner rather than later.
Yeah, Off the Grid is a great example. I think it's basically the first game that Web3 game that is fun to play. And this is like a kind of a 0 to 1 moment. Now, unfortunately, I think we need maybe 10 more like this until we see like the true revolution and see what are the mechanisms that actually work and which doesn't. So I feel like there's going to be more time needed for gaming to penetrate. Apart from gaming, I think there are some intersections, crypto and AI, that look potentially interesting. One is a project called USD AI that basically allows borrowing against GPU infrastructure. So it's a kind of a financial product that could be used by data centers. The other will be maybe GPU marketplaces. So again, like stuff around trading GPU infrastructure. And the next big thing that is kind of brewing, and I'm not sure what is the intersection with crypto, to be honest, is, in my opinion, robotics. We are seeing a lot of interesting stuff coming up when it comes to humanoid robots, and also even just, you know, a robotic hand that is basically mimicking a human hand and being able to do like very precise movements. And it's basically part of the AI stuff, you know, it's just the next step for AI. One of the challenges when it comes to robotics is training data for this industry. There is just not enough data to train these robots on. So there are a couple of startups that are trying to crack this, creating like synthetic data or maybe deep in where, I don't know, you snap a camera on your forehead and then you make a video of your hand or something with some tracking. I don't know. Like, it could be something like that. Unfortunately, deep in, so far, it's been a bit hard to pick up. Like, seems like there is no really like a super successful model working there. So all of these things that I'm trying to say is that there are definitely, you know, like seeds popping up here and there, but like which of these seeds are going to become like the big thing, I'm not quite sure. I'm just giving some directions that I'm kind of looking at right now and trying to follow.
I'm back. About gaming, I totally agree with Bobby that you have to have a great game first. So Off the Grid is definitely a fun play to game, but the most of the games in Web3 are just subpar. About AI and crypto, I'm very bullish on AI and crypto because blockchain and artificial intelligence are incredibly powerful and kind of a dystopian blockchain technologies when going in the wrong direction. But they're destined to be intertwined together because there's so much synergy between these two technologies. When it comes to AI and crypto, I would like to zoom out and imagine if we already have an AI agent, which is pretty good at my stuff. He can be here doing better job than me, but basically imitating me, my personal AI agent. And the question is about ownership, and there isn't better infrastructure about ownership for ownership on digital assets like agents besides blockchain technology and crypto. So the input is the same. If you have an AI agent which is making my job better than me, if I don't have it and I don't have the ownership of this agent, I would be laid off and have no income. But if I have the ownership over that agent, that I'll be motivated to train the agent and become better than in what I do, and maybe lease it to a company or just be employed because of this agent. And crypto and AI, there is a lot of policy to be done, in my opinion. And AI in general is a very consolidated market as well, just as gaming. We have a couple of big companies which are making whatever they want, and they're ever growing. And yes, they're bringing a lot of efficiency into the system and reaping the benefits of AI, making GDP for all of us. But this GDP is concentrated in this company and not evenly dispersed. And this kind of centralization is just a matter of time to be decentralized in a way. And marketplaces is for GPU power is one thing. A bit more complicated marketplaces like the one of BitTensor is also one way, but I would like to see more ready infrastructure for AI agents on chain, validating their actions, just operating on chain in a blockchain infrastructure, paying by stablecoins in Ethereum. So this is my bullish sentiment for AI and crypto.
Thank you. Lots of information. And I would like to take the time to answer some of the questions from the audience. Well, before we do that, maybe good to say that none of what we say is financial advice, because I already saw some of the questions coming in. When do I need to sell my Bitcoin, or is it still the right time to buy? Well, I don't know. We will see. Let me see. This is a nice one. Wouldn't TradFi blur the decentralization, and how do we expect TradFi to impact crypto overall?
Great question. So I think, the thesis that if we integrate all this DeFi stuff into TradFi, we're gonna sell our soul to the devil, basically, is completely wrong in my opinion, because what DeFi gives you is optionality. So you basically have the option to either go to a bank or to some centralized service and put your money there and use all these things, through that service. Don't care about, self-custody or anything like that. But you also have the option to exit the system and go on your own. Right now, with banks, you don't have this option. Like if somebody, if you're blacklisted from the banking system, you're screwed basically. So
you're a Canadian truck driver.
Yeah, if you're a Canadian truck driver that is against vaccines, you're basically going to be kicked out of the financial system, which basically ruins your life. And, or you could be like a political dissident in some other country and then, you're fucked. So I think having this optionality is great. So integrating all these things in TradFi is great. Having the optionality even better. So I think we are on the right path right now and all these things are, coming together nicely.
I mean, I couldn't have said it better. I would just say the following. I was working in TradFi before, and, like for people that are in the industry, they know that most things run on software that was written in the 90s, like early 2000s. So, having better rails, having more efficient settlement mechanisms, like not even touching DeFi, that's already a huge step forward. Being able to trade 24/7, being able to trade from different jurisdictions, having actual ownership of assets. I think these are all huge positives, and one way or another, we are seeing BlackRock pushing towards tokenization. And if the big dogs are doing it, it's just a matter of time until others follow as well. So, yeah, I think it's inevitable.
As long as everyone is using public blockchains, everything is fine.
All right, let's do one more question. Yeah, I think strategy-wise, this is an interesting one. How would we handle risks related to debts? So purely based from a strategic perspective when it comes to investing. How can we mitigate the risks that are involved with investing into these treasury companies that we talked about?
I think maybe for trading these instruments right now, maybe just avoid trading them at the beginning until, like there is a lot of smoke right now that eventually is going to settle and things are going to be fine. But I think the initial hype needs to calm down a little bit, like all these companies to be established, like to don't have a lot of hype and everything. Until then, the only type of trading that you can potentially do is to try to have some kind of a hype, like speculative type of trading where you're like, okay, I'm gonna, I don't know, front run or just try to be faster in, trading the news and something like that, like a very short time horizon where, something is announced, you have maybe an automated system to buy and sell, like, although usually they're outside of trading hours, so that's going to be a bit hard. So I would say that, I don't know, like for now, maybe it's just a good idea to avoid them.
I definitely second that, unless you're a hedge fund and you can run delta neutral strategies where you buy the underlying asset and then you short the stock and, fancy stuff like that. I think it's just way too risky, and I'm saying this from a lens where we've participated into pipe rounds into those that companies. You actually, as even one of the private investors, can very well be left behind from, whether it's insider information trading or dark pools and so on. So this whole segment of the market is too nascent. And then at the same time, considering that all of you are sitting in the audience, why not just hold the underlying asset? And then you're in full control. You can, actually do stuff with it, like staking it or, more complicated strategies. So there is a reason why crypto is what it is and why we follow the ethos of decentralization and true ownership and, pushing those boundaries forward. So I think while I said that this is good exposure, it's definitely not something that I would primarily focus on, especially when it comes to my portfolio.
I totally agree. I don't see the point of owning MicroStrategy shares instead of owning Bitcoin, to be honest.
Oh, I see one. So when it comes to MicroStrategy, it's actually, like for this one particularly, like not for the other DATs, but MicroStrategy allows you...
There is a bit of leverage, yeah.
Yeah, it's a free leverage, basically. So MicroStrategy, if you look at the price, it's following Bitcoin price, but you know, the beta, like the multiple, like Bitcoin moves like 10%, MicroStrategy is gonna move 20%. So it's basically a leverage exposure towards Bitcoin, but you don't pay a funding rate. So it's basically a long-term hold that you can have with no payment for leverage and have a multiplied exposure to the underlying.
Again, no financial advice. Don't give them ideas.
All right.
I mean, it works both ways, right? You can short it also.
That's why people believe that Michael Saylor has the best decision about when to buy Bitcoin. They imply that into the price. And by having so much Bitcoin, he's also moving the market in a certain direction as well.
I think he's just DCAing.
Guys, thank you. Also for the audience, thank you. If you could mention one last sentence in this panel for the audience, looking forward, shaping the investment strategies of 2026, what would it be? Just one sentence.
Well, I consider the crypto market to be very momentum driven. So just remember that you should follow fundamentals and you should track metrics and you should understand what protocols do and how they're being used. But you should also understand that there is the greater fool theory fully at play with things like meme coins, hype tokens, that get listed on exchanges and then, dump in a flash of a second. So just be vigilant, realize which strategy you're playing, and if you don't know who is the fish in the room, you are the fish. That's a famous saying. So, kind of try to stay away from risky plays without fully understanding the scope.
Yeah, basically it's a marathon. It's not a sprint. So don't get liquidated. Yeah, I mean, in order to be successful in crypto generally is basically to survive. Like if you're able to survive, then you'll be well off.
I will speak to the builders here because there are a lot of developers in the room. I don't believe in the zero-sum theory for crypto. I think the price is much bigger. So drink bigger, collaborate, and make great stuff. Don't front-run launches, steal users, and copy protocols. Just build together better things and dream bigger.
Thank you, guys. And again, no financial advice.